Andrew, January and February saw capital markets have pretty positive performance. It's been kind of a risk-on mentality ever since we entered the first of the year. Can you talk a little bit about how that's filtered into business development company total returns as well as discounts to net asset value?
Sure. Certainly has flown through to the BDC market. Overall in 2016, you saw BDCs up 24%. Year to date, they're up about 5%. From a valuation perspective, on a market cap weighted basis, trading at about a 5% premium, which if you look at about a year ago, this market overall was at a 25% discount. So from a total return perspective off the low in February of last year, you're up, call it 40% plus. So when you think about the space, you sort of go down your fundamental checklist of quality manager, quality book, stable earnings, and frankly, the names that fit in that category in many cases are trading at double-digit premiums. So certainly the sector has gotten a strong lift off the sentiment rally. We've also seen some dedicated capital coming into the space, and when you're talking about sizable capital that's dedicated long-only BDC money, and it's a $30 billion market cap universe of 50 names, you kind of create what I'll call the perfect tailwind of strong risk-on sentiment, appetite for floating rate credit, as well as just some additional capital flowing into a small space.
So on that last point, is it now a momentum trade? I mean, can you look across the 40, 50 or so publicly traded names and sort of discern value, or is simply positive returns from here momentum driven by momentum in the space?
Sure. Certainly the momentum trade has played out. I think we've seen that for the past couple of quarters. And the reality is finding value in the space right now is somewhat difficult. So I would agree that returns from here likely are driven by positive momentum, i.e. continued risk-on rally, credit continuing to tighten, as opposed to really a valuation mean reversion type trade at this point.
And has this been a rising tide lifts all boats rally in that BDCs that maybe are less interesting to you from a fundamental standpoint have performed just as well as BDCs that are a lot more interesting to you from a fundamental standpoint?
I would say generally yes. Some of the lower quality BDCs certainly have gotten a bump with the market, with a couple of small exceptions of names that have the performance has been so bad that they've managed to override the overall
right.
The overall sector rally. But I would say generally speaking, it has been a rising tide lifts all boats, absent a couple of outliers.
Turning to some macro themes, this week the Fed pushed up Fed funds rates.
Sure.
And talked a little bit about maybe some future increases. How does that flow through to BDC performance and how you think about the BDC space?
Sure. So certainly from an earnings standpoint, it's positive. About 80% on average of BDC assets are floating rate loans, and the majority typically of BDC leverage is fixed rate. So certainly from just a mathematical earnings standpoint, that's helpful. Most of the floating rate loans are going to have what's known as LIBOR floors that are about 100 to 125 basis points. So with LIBOR, or at least 3-month LIBOR now at about 115 bips, you're starting to get past some of those floors. So we should see a little bit of at least some modest earnings accretion.
Right.
So certainly from just a mathematical earnings standpoint, it's positive. The other side of that question is, well, if you are in leverage finance, and this goes for the syndicated market as well as middle market credit, and your leverage multiples somewhat stretch on the underlying borrowers, does that stress the credit quality of your portfolio? And what I would say is, if you're a lender and you're sitting at the table and saying, well, this borrower can't support 7 times leverage from the simple fact of, rates going up 50 basis points takes them from 5.5 to 7, I think there's an outside chance that you see some rate amendments. But, again, I think it's early to tell if there's any negative impact on credit quality, but I think you start to see at this point at least some modest earnings accretion now that we're past some of the LIBOR floors.
That's a good segue into my next question. I think a lot of our viewers are interested in your opinion as you tear apart private credit portfolios, what you're seeing from a credit fundamental standpoint. Are you seeing improvements? Are you seeing deterioration? Is it status quo? Can you walk us through kind of what you're seeing at the portfolio level?
Sure. So it's interesting. So overall, it has been a rising tide lifts all boats from just a price valuation perspective. Certainly has not been that way from a credit perspective.
Right.
You have seen a continued divergence in the market in terms of the quality managers continue to see strong credit performance, generally speaking. Overall, you're seeing, credit sort of at a high level is overall roughly flat. You're seeing some spread tightening, which has benefited the NAV, but also some idiosyncratic credit events in certain portfolio companies of BDCs. So I would say, generally speaking, the good managers continue to see some NAV improvement from spread tightening with flat credit metrics, whereas some of the lower quality managers have not underwritten quite as well, continue to see some NAV deterioration from just frankly poor underwriting.
But if you had to sum up your view on where we are sort of in the credit cycle, are we in pretty good shape from where you sit, or are we starting to see maybe a negative turn in the credit cycle?
I would say overall we are fundamentally sound from a credit perspective. You're seeing earnings growth, typically speaking, from the underlying portfolio companies, so I think fundamentally we're in we are overall in a strong position, generally speaking. I think the interesting thing is when you saw the energy crisis that sort of played out in 2015 and in part of 2016,
right.
You saw certain portfolio companies that ran into trouble. They went through restructurings. I think that's largely, at least it seems to be largely behind us at this point. So I think the read-through going forward is, low to medium, but still positive growth at the portfolio company level. So overall, from a credit picture, it feels like, generally speaking, we're in pretty good shape.
Andrew, anything else from a macro perspective that's on your mind as it relates to things that could affect either business development companies themselves or just the sentiment around business development companies? I mean, we're 60 days into a new presidential administration. Certainly, all of us in the capital markets world are trying to think about changes in policy and how that affects the things that we invest in. Does any of that flow through to BDCs, and is there anything that you think is sort of worth watching?
So one dark horse that I've been looking at is just simply talk around tax policy changes. Meaning, obviously, if you look at the potential for the corporate tax rate to be lower, that's positive for borrowers,
sure,
including middle market credit borrowers in the U.S. However, if part of that savings is financed by effectively not allowing interest expense to be deducted going forward, that, all things being equal, likely reduces demand for credit from the borrowers themselves. If that were to pull through, or if that were to be passed, my sort of overall read-through would be perhaps a spike in refi volumes, lower rates going forward on new loans, which would obviously be a headwind for the BDC market. So, again, too early to tell if and when tax policy happens and what it looks like. But when you start to think about things like, a change of sort of interest expense deductibility obviously would have wide-ranging impacts on the loan market.
Right, and especially, I'm assuming, for an asset class or a part of the market that really thrives on demand at the borrower level, right? And is that if tax policy were to sort of negatively impact demand, then certainly that's a challenge for BDCs.
That's correct. And I mean, anything generally speaking, you're seeing a market that's already quite competitive, right? I mean, you've had private capital formation in the space now, and the reality is anything that would further pressure rates, I think you start to think about the fee structures of these products and the risk reward, and it's already difficult to make the math work.
So on that note, does that mean that as you watch policy that would impact changes in fee structures for BDCs?
I would have to think so, just because there's a certain hurdle, I would say, from an investor's point of view, especially with rates going up,
right?
To where they just say, it just doesn't make sense at a certain point. So the reality is anything that would further pressure rates, you're already seeing some fee concessions, given that there has been pressure on spreads, right, and private credit.
Andrew, thanks as always for your comments and what's quite an interesting part of the capital markets.
Thank you, Alan.